Welcome to the Deep Dive. We sift through the articles, the research, all the notes, so you don't have to. We really try to bring you just the key insights. Think of it as your shortcut, your express lane to really getting informed on complex topics. And today, we're tackling something pretty fascinating, almost a financial paradox, you might say. How does a company build this huge, multi-billion-dollar strategy around an asset like Bitcoin? Volatile, unconventional, and how do they keep funding it without taking on, like, crushing debt or diluting shareholders too much? Well, Michael Saylor and Strategy, they seem to have engineered a really audacious answer, and we're about to dissect their latest move, this STRC offering. It's a really key piece of that puzzle.
It really is. Strategy, with Saylor at the helm as executive chairman, they're definitely way out front on this. It's a new kind of financial innovation, really. They're known globally for this super aggressive, constantly evolving Bitcoin strategy.
Yeah, it's not just buying, is it? It's like they're pioneering new ways to actually use these digital assets inside a regular company structure.
Exactly. And this latest move, it signals something even more sophisticated, maybe a new phase in how they fund things.
So our mission for this deep dive is pretty clear. We're going to unpack Saylor's latest preferred stock deal, STRC, they call it. And it was massively upsized, which is interesting in itself. We want to get into its purpose, how it actually works, the mechanics, and crucially, what it means for his whole Bitcoin capitalization strategy. You're basically going to see how cutting-edge finance is adapting to digital assets right here, using this as our case study.
Right. And to help us do that, our main source today is excerpts from Saylor's Strategic Bitcoin Capitalization and Yield Curve Development. This document gives us the core facts, the roadmap for our discussion. It lets us really get into the weeds on the technical side, the strategic layers of what they're doing with this new instrument.
Okay, let's get into it then. So, Michael Saylor, strategy. Yeah, most people just think Bitcoin. Lots and lots of Bitcoin. But like you said, the source makes it clear he's not just stacking sats, as they say. He's building this complex financial architecture around the Bitcoin. The document actually uses the phrase, building out his own yield curve. Now, anyone familiar with fixed income knows the yield curve, right? That link between interest rates and maturity dates for debt, it's fundamental.
A key barometer.
But Saylor isn't just looking at the curve. He's actively, constructing his own version, specifically for funding Bitcoin. What does that actually mean in this context? Why is it so important?
Well, that's really the core of the innovation here, I think. In traditional finance, the yield curve shows the return for lending money over different time frames. Short-term T-bills versus long-term bonds,
Right. Time, risk.
Exactly. It's a whole spectrum of debt. What Saylor's doing is taking that basic idea and adapting it. He's creating this diverse range of ways to finance Strategy's Bitcoin buying spree. So instead of just one type of loan or selling stock, he's building out this multi-layered spectrum, different credit instruments, each one designed with, different lengths, different risk levels, different expected returns for investors.
Okay, so it's not just one big loan. It's like a menu of financing options.
Precisely, a curated menu. And each item appeals to different investor tastes, different time horizons, but they all funnel back to the main goal, supporting and growing the company's Bitcoin stash. It's not just theory either. It's a very active, dynamic financial setup. He's consciously building this diverse capital stack.
But we've seen this before, haven't we? This is the first layer.
No, absolutely not. The source actually points this out. It mentions the earlier preferred shares, STRD, STRF, STRK.
Right, I remember those.
Yeah, they were distinct offerings, different times, probably different terms, different yields, aimed at different investors. So by issuing these various types of preferred stock over time, Saylor's been systematically adding layers to this curve. Each new offering is like another rung on the ladder, giving Strategy more ways, more distinct pathways to raise money.
It's about building flexibility into how they fund this long-term bet.
Exactly. Flexibility. And this whole multi-layered approach, including the new STRC we're focusing on today, well, it just highlights the company's continued ambition to aggressively expand its Bitcoin holdings. That's a direct quote from the source.
Aggressively expand. Yeah.
It signals this isn't just a one-off capital raise for some temporary goal. No, it's a continuous, adaptable plan. It fuels this ongoing, systematic Bitcoin accumulation, shows a really deep, long-term belief in the asset.
So it's about creating a robust, kind of sustainable financial engine that can keep feeding that Bitcoin strategy for the long haul, whatever the market's doing.
Precisely. Regardless of market swings or interest rate changes, that's the goal.
Okay, it definitely sounds like a sophisticated strategy, playing chess, like you said. But building this whole financial ecosystem, as you put it, around one single asset type, even a massive holding like Bitcoin, doesn't that introduce its own kind of risk, like concentration risk? What vulnerabilities does this diversified credit curve actually help with? And does it create any new risks by being so complex?
Yeah.
Why is having this range of options, this credit curve, so vital for strategy?
That's a really insightful point. And yeah, it gets right to why this is so clever, but also worth examining closely. While, yes, it does concentrate the asset risk in Bitcoin, the credit curve is designed to mitigate the financing risk significantly.
Okay, how so?
Well, first, it gives them that crucial diversification of capital sources. That's huge.
Yeah.
By having different types of preferred stock, maybe other debt down the line, who knows?
Yeah.
They can tap into completely different pools of investors.
Right. Not everyone wants the same thing.
Exactly. Some investors might be purely focused on income. They want something short duration, perceived as lower risk, like this new STRC offering. Others might be okay with a longer time frame, maybe even willing to handle more price movement for potentially higher returns down the road.
So you can attract different kinds of money. Hedge funds, pension funds.
Pension funds, family offices, maybe even sophisticated retail investors. It broadens their reach way beyond just one type of lender or equity buyer. And that diverse sourcing also helps them manage their financing costs, right? They can pick the instrument that's cheapest or most in demand at that moment.
That makes sense. Optimizing the cost of capital.
Which is key for anyone, especially a company making such big bets. And second, maybe even more critical, is the flexibility and resilience it provides. Having this well-built yield curve gives strategy amazing agility. They can raise money in all sorts of market conditions.
How does that work?
Well, imagine traditional debt markets get tight. Maybe rates are soaring or there's economic jitters. Strategy isn't stuck relying on just that one channel. They can lean on whichever part of their curve is currently attractive to investors. So if it's a risk-off mood, maybe investors pile into the stability of something like STRC, the short duration senior piece.
Oh.
If the market's more bullish, maybe investors are more interested in longer duration options, hoping for bigger returns. This flexibility lets strategy tailor their fundraising to what the market actually wants at that time.
So they can keep raising capital for Bitcoin pretty consistently, regardless of the wider market mood or where interest rates are.
That's the idea. It's absolutely vital when you're making these bold, long-term plays on an asset class like Bitcoin that, let's face it, can be volatile.
Yeah, just a bit.
It lets them stick to their strategy without being totally whipsawed by the capital markets. It's like building financial shock absorbers around their core bet.
Okay, so that's the big picture strategy building this credit curve. Now, let's zoom in on the newest piece, the one getting all the attention. STRC, or stretch, as the source calls it. It's described as a new short-duration layer, senior, and low and expected volatility.
That sounds like a really potent mix, especially underpinning a Bitcoin strategy.
Sure.
So what exactly is STRC? How does it work? Why is it such a big deal in this whole structure?
Yeah, STRC is definitely a standout instrument in this setup.
Yeah.
Really innovative. Okay, at its core, the source says STRC is a senior perpetual preferred stock offering a variable monthly dividend. Let's kind of unpack that.
Okay.
So preferred stock, it's a hybrid, right?
Yeah.
Part equity, part debt and how it behaves, gives you ownership like common stock, but pays dividends more like a bond's interest payments, typically fixed dividends.
Predictable income, usually.
Right. But STRC is interesting because the dividends are variable. That gives strategy flexibility.
Yeah.
And they're paid monthly, which is a big plus for income investors seeking regular cash flow.
Monthly, okay? And perpetual, what does that mean here? Perpetual means it doesn't have a maturity date. Unlike a bond, which has a fixed date when the principal has to be paid back, strategy doesn't have to redeem STRC at any set time.
Ah, so it's potentially on the books forever.
Theoretically, yes. That gives the company huge flexibility on its balance sheet, no looming principal repayment deadline. That's powerful if your goal is long-term asset accumulation.
Makes sense, though they probably have ways to call it back if they want to.
Oh, absolutely. They usually retain call options for management, but from the investor side, your capital is theoretically invested indefinitely, earning that monthly dividend.
And senior. That's important too, right?
Very important. Senior means if the worst happens, like liquidation, these preferred stockholders get paid back before the common stockholders.
Adds a layer of safety.
Reduces risk compared to just holding the common equity, yes. Now, its specific role in the yield curve strategy is critical. It anchors the short end of strategy's BTC credit curve.
Okay, the short end, even though it's perpetual.
Yeah, it sounds counterintuitive, but the design and the mechanisms around it are meant to give it short duration characteristics. Low price volatility, predictable income, behaving like a short-term bond or money market fund.
But with a better yield, presumably.
Much better yield, we'll get to that. But the point is, it creates this distinct, more conservative entry point into Strategy's financing mix. It appeals to a whole different group of investors who prioritize stability and regular income over maybe betting on Bitcoin's price going up.
So who is the target investor then?
The source is explicit.
Mm-hmm.
It's designed to appeal to yield-seeking investors who want stability near par value.
Mm-hmm.
So not the Bitcoin maxes necessarily. It's for people, institutions maybe, looking for solid, reliable income with price risk that's actively managed.
That definitely broadens their investor base.
Yeah.
Taps into more risk-averse capital.
Hugely. Diversifies their funding sources even more. Shows Saylor understands different investors have different needs. And then there's the scale. This is where it gets really eye-popping. The offering size was just dramatically upsized.
All right, you mentioned that. What were the numbers again?
The initial announcement just days before was targeting $500 million, which is already a decent chunk of change.
Yeah.
But they ended up closing the deal at a massive $2.5 billion.
Wow. 5 times the target.
5 times. It signals just incredible investor demand, huge confidence, or maybe just Saylor's phenomenal ability to find that demand and capitalize on it.
That kind of upsizing is pretty rare.
Very rare. Shows a deep well of capital was ready and waiting for exactly this kind of product, the specifics. 28 million shares priced at $90 each, totaling $2.50 billion.
Okay.
And the yield, well, it's undeniably attractive, especially now. An effective yield of 9.5%, 10.0% paid monthly.
9.5% to 10%.
Yep.
Paid monthly.
Yep. That makes it incredibly competitive for income investors compared to traditional fixed income.
Okay.
And being paid monthly just adds to the appeal for portfolios needing regular cash flow. So you put it all together, senior perpetual, variable monthly dividends, managed stability, and that killer yield. STRC becomes this really key pillar in Strategy's whole financing machine, designed to keep fueling the Bitcoin buys.
Okay, that 5-fold increase, the $2.5 billion raised, that's a massive signal from the market. What do you think really drove that kind of extraordinary demand? Especially when it's, ultimately linked to a company whose main asset is Bitcoin, which still makes some traditional investors nervous.
It's a great question. I think it's a combination of things. First, yeah, that yield. 9.5, 10% in this environment, that jumps off the page.
Absolutely.
But I think it's more than just the yield number. It's the perception of managed risk. Like you said, Bitcoin can make people nervous. Saylor isn't just throwing out a high yield and hoping for the best. He's offering it with what seem like very sophisticated guardrails.
Right. Investors are buying into the structure, not just the headline rate.
Exactly. They're buying into the financial engineering behind it. And that leads directly to your next point. How does Strategy actually plan to maintain the stability near par value the source talks about?
Yeah, because high yield usually means higher risk, more price swings.
Yeah.
But STRC is supposed to be stable.
Yeah.
How do they square that circle? What are these mechanisms?
This is where the real cleverness of STRC comes in, I think. It's what makes it different. The stated goal, per the source, is keeping it trading close to $100, specifically aiming for a tight band between $99 and $101.
It's a very narrow range.
Very narrow. And to hit that target, Strategy has built this toolkit of dynamic levers. Think of it like a self-correcting system designed to keep the price right there.
Like a thermostat for the stock price.
That's a great analogy, yeah. Price dips below $99, they turn up the heat. Price pops over $101, they open a window. It's this active, ongoing balancing act.
So what's in the toolkit? What are the levers they can pull?
Okay, the main ones mentioned are adjustable dividend rates. That's probably the key one.
Yeah.
Changing the dividend directly impacts how attractive the stock is for yield.
Makes sense. More yield, more demand, price goes up, less yield.
Price might soften. Then there are secondary issuance windows. That means Strategy can issue new shares into the market if needed, increase the supply,
Okay.
and finally, call options above par. This is Strategy's right to buy back shares from investors at a set price, usually a bit above the original $90 or the target $100 par.
Got it. So how do they use these tools in practice? Like if the price drops below $99?
Right. So scenario 1, STRC dips below $99.
Yeah.
Maybe the whole market's down or just less demand for some reason. Strategy can respond by, quote, raising dividends and halting sales.
Okay, raise the payout, stop selling new shares.
Exactly. Raising the dividend makes it immediately more appealing to income investors, should boost demand, push the price back up towards $99 or $100, and halting new sales stops more supply from hitting the market and pushing the price down further. It signals they're actively managing it, committed to stability.
Okay, that makes sense. What about the other way? If it goes above 101 there's too much demand.
Scenario 2. STRC trades above 101 Hours. Strong demand is pushing the price too high for its stable mandate. Strategy can then respond by issuing new shares and calling the stock.
Right. Issuing new shares increases supply, cools off the price.
Precisely. Dilutes the demand pressure across more shares. And the calling the stock part means they can buy back shares, usually at a small premium.
So that caps the upside for investors, but maybe gives them a nice exit while controlling the price.
Exactly. It provides a potential profitable exit for some holders, controls the overall supply, and stops the price running away too far above the target. These actions work together, this dynamic system, to try and create that stability investors want while still delivering that attractive income. Especially valuable, as the source notes, in the current interest rate environment.
Okay, and there was something about protecting investors if they lower the dividend too.
Yes, absolutely crucial detail for investor protection. The dividend is variable, but there's a limit on how much they can cut it. The source says any step-downs in the dividend are capped at 25 basis points, plus the maximum decline in the 1-month secured overnight financing rate, SOFR, over the period.
Okay, break that down a bit. 25 basis points plus the drop in SOFR.
Right, so 25 basis points is 0.25%. SOFR is a key benchmark interest rate, reflects overnight borrowing costs, basically. This formula means there's a clear, transparent floor on how much the dividend can be reduced in any given period. They can't just slash it arbitrarily.
It's tied to a market rate, SOFR, plus a fixed amount.
Exactly. It gives investors a quantifiable limit on potential income reduction. It provides assurance that their income stream has a safety net, even if broader interest rates are falling.
So it's this combination of active management tools and built-in structural protections that aims to keep STRC stable and appealing.
That's the design. That's what attracted $2.5 billion.
Okay, so it's not just the high yield floating out there. It's high yield plus these sophisticated guardrails. It really does sound like a finely tuned machine, almost like a hybrid bond equity thing, but designed specifically for income investors who want stability. And all this against the backdrop of the company's big Bitcoin play. So what does this mean for someone maybe looking at more traditional investments? How does STRC really stack up against, say, your standard money market fund or short-term bonds? Because let's be real, 9.5% to 10% yield for something aiming for stability near par.
Yeah.
That's going to turn heads.
It absolutely turns heads. And that's exactly the point, right? STRC isn't just existing in a vacuum. It's designed to actively compete for capital against those very traditional, conventional short duration options.
And the numbers make the case pretty clearly.
Oh, dramatically. The source highlights it perfectly. STRC's 9.5%, 10.0% effective yield. You put that next to the 4% or so available for money market funds or treasury bills at the time.
It's more than double.
More than double. That's not just a little better. It's a massive yield advantage. That alone forces income investors and treasury managers to sit up and take notice. And it just reinforces who they're targeting. Investors looking for higher yield without significant price volatility.
Right. Not the Bitcoin speculators, not the ultra-conservative bank deposit folks.
Yeah.
Someone in between.
Exactly. A segment looking for strong, steady income, but with that price risk actively managed through all those mechanisms we discussed. And this positions it competitively against things like commercial paper and bank deposits.
Which usually offer much lower yield.
Much lower. Commercial paper, that short-term corporate IOU, and bank deposits. They're seen as super safe, sure, but the return is minimal compared to STRC. STRC is essentially saying, we can offer you vastly superior returns, and we have sophisticated mechanisms designed to give you a similar level of price stability. It's trying to bridge that gap.
And that's especially appealing right now, you think?
The source emphasizes that in the current interest rate environment. With rates having risen, investors are actively hunting for higher yields. They want to beat inflation, get better returns on cash. STRC gives them that high yield without forcing them way out on the duration curve, like long-term bonds, which have rate risk, or into highly speculative stuff.
It's a unique spot in the market.
It really is.
Yeah.
High income, managed volatility, plus maybe a little indirect exposure to the whole digital asset theme that many are curious about. It definitely pulls attention and likely capital away from those lower yielding traditional options. It forces people to rethink what short duration or stable income can mean.
So stepping back again, connecting this to the bigger picture, what does Saylor's overall strategy here really signify?
I think it represents a genuinely significant innovation in corporate finance, truly. It shows how companies can get creative using traditional tools like preferred stock, but turbocharging them with modern financial engineering, all to finance big investments in totally non-traditional assets like Bitcoin.
So it's not just about buying Bitcoin. It's pioneering new ways to fund holding digital assets within a normal company structure.
Exactly. Merging old school treasury management with new world digital asset strategy and doing it in a way that attracts serious, sophisticated capital.
Does this become a model for others then? Could other companies copy this yield curve approach?
That's the multi-billion-dollar question, isn't it? Is Saylor creating a blueprint, not just for Bitcoin, but for any company wanting to finance holdings of non-traditional, maybe illiquid or volatile assets?
Like what? Give me an example.
Okay, imagine a big real estate company wants to tokenize a portfolio of buildings. How do they raise money against that? Banks might struggle with it.
Right.
Or a gaming company holding valuable in-game assets as part of its treasury. Or an exchange funding portfolios of carbon credits. Saylor's model shows if you layer different financial instruments, tailor each one to a specific investor risk profile, you can potentially unlock significant capital against assets that traditional finance finds hard to handle.
Creating custom liquidity for new asset classes.
That's a great way to put it. Designing a capital structure that fits the unique profile of these emerging assets. The implications go way beyond Bitcoin.
And the fact that STRC was so successful, that huge $2.5 billion raise, what does that tell us?
Well, it's not just a win for strategy. It signals real, strong market appetite for these kinds of structured products, even when they're linked directly or indirectly to Bitcoin.
So institutions, sophisticated investors,
Yeah,
they're getting more comfortable.
it suggests they are, yeah. Especially if the product offers compelling risk-adjusted returns and has clear mechanisms for stability and protection like STRC aims to. This market acceptance could really open the door for a whole new wave of corporate financial instruments.
Yeah.
Could fundamentally change how companies think about and fund what's on their balance sheets over the next decade or two.
It's a real-world proof of concept for a very innovative approach.
Absolutely. Validation in the marketplace.
It is truly fascinating to watch. Seeing a company blend cutting-edge digital assets with, tried and true financial engineering, just refined to a high degree. This deep dive really underscores that the future of corporate finance, it's probably going to be way more inventive, more adaptive than we've maybe seen in the past, constantly evolving to handle new assets, meet new investor demands. What Saylor and Strategy are doing, yeah, it's about Bitcoin, but it's also about writing this entirely new financial playbook, challenging how we think about liquidity, stability, corporate treasury itself.
Yeah.
So just to recap the main points from our deep dive today, we looked at Michael Saylor's big vision, building this comprehensive Bitcoin credit curve for flexible, resilient financing. We then drilled down into STRC, the latest preferred stock offering. Key piece of the curve, high yield, senior perpetual, but designed for stability, aimed right at yield-seeking investors. We unpacked those innovative stability mechanisms, the adjustable dividends, the call options, all working to keep STRC trading near par. Real financial engineering there, plus that dividend cap for protection.
Right, the toolkit.
And we saw its strong competitive position, offering more than double the yield of traditional short-term options. Makes it stand out, especially now.
Definitely a compelling alternative.
It's just a remarkable case study in forward-thinking finance.
It really is. And it leaves you with a provocative thought, perhaps. Considering how sophisticated these mechanisms are for STRC's stability and yield, what does the sheer success of this $2.5 billion issuance tell us about Strategy's own long-term confidence? Their confidence in managing and growing this massive Bitcoin position through all kinds of market weather, and maybe even more broadly. How might this market acceptance, this validation of a complex Bitcoin-linked instrument, how might that shift the perception among other institutions? Could it make Bitcoin seem more like a legitimate, maybe even integral treasury asset for corporations down the line?
Yeah.
It really makes you wonder about the future evolution of corporate balance sheets. suggests that what maybe seemed purely speculative just a few years ago could become part of innovative mainstream finance.
Absolutely. That's a really compelling thought to leave our listeners with, something to definitely mull over as we all watch these financial markets evolve so rapidly. We really encourage you to keep exploring how this kind of financial innovation is reshaping everything traditional markets, corporate strategies. What we dissected today with strategy and STRC is just one powerful example of this much bigger transformation that's underway. It's going to define finance for years to come. Thanks for joining us for another deep dive.